Good afternoon, everybody, and thank you for joining us today at a very special Money Marketeers event. We appreciate everyone taking time out of their day to meet with Mr. Nelson and hear what he's got to say. I think you can tell by the title of today's speech that it's certainly going to be an interesting topic. Just as a brief bit of housekeeping, if you're okay before we get started, for those of you new potentially to the organization and to the event, we are the Money Marketeers. We are a forum engaged in meaningful and substantive dialogue with U.S. policymakers, senior Federal Reserve officials, and other distinguished speakers whose words and actions have the potential to influence the global financial markets. In our quest to provide a greater opportunity, educational opportunity to aspiring financial professionals, Money Marketeers provides scholarships to deserving NYU Stern School of Business students, and we are a 501c3 charity. To that end, our organization has just, awarded, you would say, our 2021 scholarships to both Daniel Abudi, who's an MBA in 2021, and Justin Lee, MBA in 2021. So congratulations to both of them on the hard work and the well-earned scholarship. I believe Mr. Nelson will be here momentarily, but by way of quick introduction, Mr. Nelson, in addition to his work at BPI, he is an adjunct professor at Georgetown University and was the deputy director of the Division of Monetary Affairs at the Federal Reserve Board, where his responsibilities included monetary policy analysis, discount window policy analysis, and financial institution supervision. Mr. Nelson attended the Federal Open Market Committee meetings and regularly briefed the board and the FOMC, and he was a member of the Large Institutional Supervision Coordinating Committee, the LISCC, and the Steering Committee of the Comprehensive Liquidity Analysis and Review, that's CLAR. He has chaired and participated in several BIS working groups on the design of liquidity regulations, and most recently chaired the CGFS Market Committee Working Group on Regulatory Change and Monetary Policy. He was the founding chief of the new Monetary and Financial Stability section of Monetary Affairs, and in 2007 and 2008, he visited the Bank for International Settlements in Basel, Switzerland, where his responsibilities included analyzing central bank responses to the financial crisis and researching the use of forward guidance by central banks. He returned to the board in the fall of 2008, where he helped design and manage several of the Federal Reserve's emergency liquidity facilities. So he was in the center of it all. He also served as executive managing director, chief economist, and head of research at the Clearinghouse Association, and was a chief economist of the Clearinghouse Payments Company. We really appreciate, Bill, you coming here today. Certainly the topic is unbelievably timely, given what we saw this morning. And welcome to the Money Marketeers. We look forward to your comments. We will be opening up to Q&A, and I will do my best to get as many questions as we can, given Mr. Nelson's schedule. But with that, thank you so much, Bill, and the floor is yours, sir.
Oh, thank you, Elaine, and thank you for that kind introduction. It's a real pleasure to speak to your group. I've attended several of your meetings, and they're always incredible. Okay, well, Chair Powell said last month that the FOMC was not yet talking about when to start tapering its asset purchases, but you can be certain that the committee is talking about how it will go about normalizing policy when the time comes. Expanding your balance sheet by $3.5 trillion without a plan for how you return to normal would be central banking malpractice. Indeed, as the Fed expanded its balance sheet between 2009 and 2014, the committee discussed its normalization plans at least 4 times and issued 2 different sets of exit principles. Fed communications suggests that it envisions normalization proceeding roughly like last time. In my remarks today, I'm going to flesh out what normalization along that previous timeline might look like, argue that such an approach could be too slow this time, demonstrate that if the Fed had to tighten faster and more substantially, it could end up losing a lot of money, and chart a path for reducing the Fed's balance sheet to a much smaller size than it is now. So before diving in, I'd like to note that my remarks reflect my own views and not necessarily those of BPI's member banks. So the FOMC's forward guidance currently states that it will continue to expand its treasuries portfolio at $80 billion a month and its MBS portfolio at $40 billion a month until the economy has made substantial further progress toward its goals of maximum employment and 2% inflation. That benchmark will be gauged relative to the situation in December 2020, when the committee adopted the guidance. The first step in normalization will be adjusting the statement language so that it characterizes the extent of progress toward the committee's employment and inflation goals. After that, it's just a matter of choosing a sequence of adjectives that end in substantial. After the committee declares that substantial further progress has been made, it will begin to taper the rate of balance sheet expansion. The committee wound down QE3 by tapering both its Treasury purchases and its MBS purchases by $5 billion each month. At that pace, tapering would take 16 months. Tapering Treasury purchases this time by $10 billion and MBS by $5 billion each month seems more likely, shortening the process to 8 months. The next step in normalization will be to raise the target range for the federal funds rate. Again, they would first have to adjust the statement language, but that adjustment could start during tapering. The forward guidance indicates that they will tighten when the economy is at maximum employment and inflation is at or above 2% and on track to modestly exceed 2% for some time. As with the asset purchase guidance, the committee would characterize the economic situation in terms of proximity to those goals and then incrementally adjust that characterization. Once the conditions are met, the Fed will raise its target range for the federal funds rate, probably initially to a range of 25 to 50 basis points, and guide the funds rate into that new range by increasing the interest rate it pays on reserve balances, the IORB rate, and the interest rate it pays on overnight repurchase agreements, the ONRRP rate. When the Fed tightened in 2025, it initially set the IORB rate at the top of the range and the ONRRP rate at the bottom, and the Fed funds rate traded in the middle. However, at that time, there were $2.8 trillion in reserve balances in the system. Reserve balances are currently $4 trillion and could easily be $5 trillion or higher at liftoff, so the funds rate could end up much closer to the ONRRP rate. To prevent the funds rate trading at the bottom of the range, the Fed could set the IORB and ONRRP rates closer together and near the middle of the range. If they did so, use of the ONRRP facility could be far higher than it's been in the past. If this is the FOMC's plan, it might want to revisit the profound concerns it had when it created the facility about expanding the Fed's involvement in financial markets and facilitating flights to quality, concerns that led it to put caps on use of the facility. For reasons I will discuss in a minute, I don't think interest rate normalization will follow its previous timeline, but if it does, it will take a long time. The FOMC has been emphasizing repeatedly recently that the current rise in inflation will be temporary and that it is not going to respond to forecasts of inflation, just actual inflation. Consequently, before tapering will begin, the FOMC would seem to have to observe the current rise in inflation and either one, watch it recede and then wait for inflation to rise up again, or two, if it didn't recede, wait until it was clearly not transitory, perhaps because it was becoming embedded in inflation expectations, before it can declare that the economy has made substantial progress toward 2% inflation. I don't see how that process can take less than a year, so unless they adjust their script, it is hard to see tapering starting sooner than May 2022. Let's suppose the committee tapers its Treasury purchases at twice the rate it tapered in 2014, in which case balance sheet expansion will end in January 2023. The committee then begins to raise the target range for the funds rate. Assume it does so at the same pace as in 2017 and 18, 25 basis point increments at every meeting until policy is neutral. The committee currently judges a neutral nominal funds rate to be about 2.5%, which would be reached in June 2025, 4 years from now. There are good reasons, however, to think that the committee might need to tighten policy more rapidly and by a greater amount. Recoveries from financial crises tend to be slow because growth is impeded by the repair of the damaged financial system. But the recession last year was caused by a pandemic, and as the pandemic recedes, the return to normal could be rapid. Indeed, last week's employment report notwithstanding, the economy appears to be growing strongly. In addition, the committee's emphasis on waiting for realizations rather than responding to forecasts and its new average inflation targeting framework both appear designed to let the economy gather considerable momentum before responding, at which point policy would have to move quickly from providing stimulus past neutral and to a level where it was imparting restraint. Alan, if you could please show the first slide. To consider what such a path might look like, it is worth reviewing the two most recent times the Fed engineered a soft landing. This graph shows the federal funds rate, highlighting the mid-1990s and mid-2000s tightening cycles. In both instances, achieving a soft landing required a 4 percentage point increase in the real funds rate and took, on average, 1.5 years. If inflation rises 1 percentage point to 2.5 to 3%, then the nominal funds rate would need to be raised to about 5% to achieve a 4 percentage point real tightening, as in these two previous episodes. If the appropriate time to begin tightening is now, somehow the FOMC would have to begin to taper its balance sheet expansion and increase the funds rate by 475 basis points by the end of next year. Thank you, Alon. You can take the slide down now. One implication of such a substantial and rapid rise in interest rates seems to have generated little notice. Like any financial institution that funds long-term assets with short-term liabilities, if interest rates go up, the Fed's net income will decline, and it could make losses. If interest rates have to go up a lot and go up quickly, the losses will be big. Consider the implications for Fed earnings of having to raise the Fed funds rate to 5%. It's complicated to project the whole scenario. Further balance sheet expansion, then rapid tightening and balance sheet runoff. But to get a rough idea, it is simple to consider what would happen right now if the IORB rate were 510 basis points instead of 10 basis points, and other short-term interest rates were also 500 basis points higher. As of last week, the Fed had about $4.5 trillion in interest-paying liabilities, $3.9 trillion in reserve balances, $388 billion in reverse repos, and $326 billion in what are called other deposits, of which perhaps $235 billion are interest-bearing. If short-term interest rates were 5 percentage points higher, Fed interest expense would increase by $225 billion. Interest income would be essentially unchanged initially, but it would rise gradually as securities matured and the Fed reinvested the proceeds. Fed net income last year was $90 billion, so this back-of-the-envelope analysis suggests it would initially make losses of $135 billion at an annual rate, and elevated but declining losses would persist. Remarkably, even though the Fed only has capital of $32 billion, despite those losses, the Fed's capital would not go negative. Instead, the Fed would offset the losses with the balance sheet item the Fed's accountants call deferred assets remittances to Treasury, but that everyone else calls the magic asset. The magic asset is defined in footnote 3Q of the Fed's annual financial statement as the amount of future profits that the Fed will retain before it again passes its profits over to Treasury. For every dollar of losses, the Fed would increase the magic asset by $1. At the same time that its net income turned negative, the Fed would experience large unrealized losses on its securities portfolio. The duration of the Fed's portfolio is probably a bit more than 5 years and would be longer still if mortgage prepayments slowed to a trickle as mortgage rates rose. If overnight rates went up to 5% and QE4 ground to a halt, 5-year rates would likely go up to at least 4%, 3 percentage points higher than currently. Under these assumptions, a rough guess is that the value of the FOMC's $7 trillion securities portfolio would decline by about 15%, or over $1 trillion. Even though those losses would be unrealized, they are not imaginary. Because the purchases are funded to a large extent by short-term borrowing, the losses roughly correspond to the present value of the decline in future net interest income paid to the U.S. Treasury. In other words, these costs would have real consequences for federal budget deficits and ultimately would be shouldered by U.S. taxpayers. It is worth emphasizing again that these are just ballpark approximations under a stress scenario. I'm working with Andy Levin, a former colleague at the Fed, now at Dartmouth, to develop more sophisticated forecasts under a range of scenarios. It is also important to note that neither negative profits nor the unrealized losses would, in and of themselves, interfere with the ability of the Fed to implement monetary policy. Returning to the normalization process, the size of the balance sheet will be normalized when reserve balances decline to a level that the Fed decides is the minimum amount necessary to conduct monetary policy efficiently and effectively. At the end of 2019, that minimum amount appeared to be about $1.7 trillion, a $300 billion buffer over an estimate of the structural demand for reserve balances of about $1.4 trillion. The structural demand for reserve balances is the level below which the Fed funds rate would exceed the IORB rate. According to Chair Powell, the Fed will probably normalize its balance sheet by just ceasing to reinvest principal payments from its treasuries and MBS. The Fed could, of course, shrink the portfolio faster by selling assets, but it is unlikely to do so, in part because such sales could disrupt markets, but also because it might then have to realize losses on its securities holdings. Not only would those losses reduce Fed profits further, they would also make it harder for the Fed to maintain that its large unrealized losses were irrelevant. According to FOMC meeting transcripts from 2012 and 2013, avoiding having to realize losses was one of the reasons that the Fed chose not to sell assets when it last shrunk its portfolio. Structural demand for reserve balances has reached the high level of $1.4 trillion for several reasons. First, banks concluded that they needed a much higher level of cash based on their experiences during the global financial crisis. Second, a raft of new liquidity requirements were imposed through both the regulatory and examination process. Many of those regulatory requirements treat reserve balances and Treasury securities equally, but rank and file examiners and those reviewing resolution plans prefer that banks hold reserve balances, which are more liquid. Those factors alone can't explain the continued growth in the structural demand for reserves after the post-crisis regulatory regime was in place. In a variant of Say's law, the additional growth in demand occurred because of the high level of supply. When reserve balances are superabundant, they are cheap. That is, the interest rate that the Fed pays on reserve balances is above the interest rate on alternatives. Banks choose to satisfy their liquidity needs with reserve balances, and bank examiners get used to those choices. It's not just examiners, of course. Like any large institution, banks get used to certain ways of doing things and can be resistant to change. Likewise, credit rating agencies and bank investors understandably base their views of what is prudent on what has been normal practice. Alan, could you please show the second slide? So this whole process acts as a ratchet. Structural demand for reserve balances ends up just below whatever level the system has gotten used to. You can see the process in this scatter plot of the spread between the Fed funds rate and the interest rate on reserve balances against the level of reserve balances. The purple dots show the relationship as the Fed expanded its portfolio between January 2009 and October 2014. And the orange dots trace out the relationship as the Fed contracted its portfolio through September 2019. As can be seen, the spread widened faster when the Fed contracted than it narrowed when the Fed expanded. I think the graph that we have up there is the reverse, but I hope the story was clear. So thank you, Alon. You can take the slide down now. To be clear, I'm not saying with reserve balances at $4 trillion, a bank's short-run structural demand for reserves has shifted up to $3.9 trillion. But I fully expect that structural demand is shifting up and will continue to do so after liftoff because the IORB rate will be above market rates. Suppose structural demand rises to $1.7 trillion, putting the normalized level of reserve balances at $2 trillion after adding a $300 billion buffer. Suppose further that the Fed securities portfolio had expanded to $8 trillion and that there were $5 trillion in reserve balances. If the securities portfolio declines 10% a year, roughly corresponding to the portfolio's 5-year duration, and currency grows at the 5% trend growth rate in nominal GDP, the balance sheet would be normalized about 4 years after redemptions began. The Fed could get substantially smaller, however, if it decided to. It might decide that the financial risk associated with being so large was unacceptable. It could conclude that bank structural demand for reserve balances would just continue to rise as long as the IORB rate was above market rates. It also might decide that having an unbounded balance sheet left it open to political pressure to monetize the debt or expand its role in financial markets. I also wonder how a view that there is no real cost to getting larger has affected decision-making within the Federal Reserve System. If incremental decisions about increasing the balance sheet are perceived as having no cost, that too acts as a ratchet. The most important thing that the Fed could do if it decided to get smaller would be to create a modest financial incentive for banks to economize on reserve balances rather than subsidizing the holding of reserve balances. Once that happened, banks would gradually start finding alternatives, and bank examiners and investors would become accustomed to those alternatives. Short-run structural demand would slowly start to move down. That's what was beginning to happen in 2018 and 19, when the gradual decline in reserve balances shifted the repo and Fed funds rates above the IORB rate. The Fed could create that incentive, as it did in 2018 and 2019, by nudging reserve balances down to structural demand. Once there, it would, of course, have to control volatility in the supply of reserves and accommodate variations in demand. A standing repo facility would be a helpful tool under those circumstances because it could help put a ceiling on interest rates and automatically inject reserves when needed. The structural demand for reserves could be reduced further by recognizing that a deposit at the central bank and a collateralized line of credit from the central bank are economically nearly identical. Both are promises to provide funds on demand in the future. Structural demand for reserve balances is high because each and every bank is pre-positioning at the Federal Reserve funds it might need in a contingency. However, rather than inefficiently providing contingency cash to every bank that it might need in advance at a subsidized rate, the Fed could instead provide each bank for a fee a collateralized line of credit. Such lines, called committed liquidity facilities, or CLFs, are already included in the Basel standard for the liquidity coverage ratio and are in use by several countries. If the Fed were to offer such lines of credit and count them toward all of banks' different liquidity requirements, the demand for reserve balances could be reduced significantly without sacrificing safety and soundness. Moreover, the Fed would collect fees on the lines rather than paying a subsidy on the deposits. So what's the bottom line? What should the Fed do? First, it should clearly articulate an exit plan, the sooner the better. Second, despite its forward guidance, it should start tapering its asset purchases. With the economy growing strongly, the marginal added stimulus they provide is unnecessary, and each purchase just makes normalization harder. Third, it should start preparing Congress and the public for the possibility that it will make substantial losses. Lastly, it should reconsider, this time with public notice and comment and congressional review, its large balance sheet approach to conducting monetary policy. Thanks.
Thank you very much, Bill. I appreciate it. That was very insightful. And just as a reminder to our audience, you should have a window available to you to ask questions. A few of you have already started, but we want to try and make this as open as a forum as possible. Bill's been kind enough to take as many questions as he can, given his time allotment. Why don't we just start with something straight down the middle to start us out, Bill, if you're okay. You mentioned that the Fed could come under pressure to monetize the debt if it treats its balance sheet as unbounded. Could you explain what you have in mind specifically, or how you see this sort of developing?
Yeah, happy to. So when the Fed, under the Fed's previous operating system back before the great financial crisis, it kept reserve balances scarce. And consequently, if it was asked to increase its balance sheet to accomplish some objective, it could honestly and accurately say, gosh, sorry, we can't do that, because if we were to, we would lose control of interest rates and we couldn't achieve our monetary policy objectives. But now the situation is different. The Fed is operating under a regime where there is really no effective limit on how big it can get, at least for the purposes of conducting monetary policy. So it doesn't have the same ability to deflect such requests. And Alain, I provided you a couple slides, and one of them was a quote about funding that maybe is kind of relevant that I could, if you could, if you can.
Yeah. Unfortunately, that one didn't make it through. I apologize. That's on my fault.
Oh, no worries. It's a quote from the that was from the it was a quote about the refunding of the funding plank of the Green New Deal. So basically, the proponents said, well, we don't really need to worry about funding it because basically the Fed just prints the money, and we can have the Fed print the money. And I think that sentiment, could be applied pretty widely.
Right. Within that regard, let's stick on the balance sheet again for another moment, if you don't mind. When you're talking about the Fed's internal decision-making sort of bias is towards an ever-expanding balance sheet, where is that really ultimately going? What's the meaning of that kind of bias in monetary policy for the FOMC, in your opinion?
So I guess it's kind of hard to know where it ultimately ends up, right? So the last step of the Fed's response to the great financial crisis was a flow-based asset purchase program. And as I've written about in an article that was in the FT a couple of years ago, when you sort of walked back through the transcripts and talked about the decision making, I mean, that program was initially supposed to be about a $500 billion 6-month program, but a number of the committee members said, I don't see how this isn't a $1.2 trillion program. And that's, it indeed ended up, I forget the figures, but being something along those lines or much higher and lasting for well over a year. So, and that was, I think, a decision made against a backdrop of there being no real reason to be concerned about size. And that's fine. But once again, if you look at December of 2020, so it seems unambiguous that the Fed's actions in March and April of 2020 of acquiring securities were completely desirable and appropriate under the circumstances. The Fed then established a pattern of buying a certain amount of securities each month, 120 billion of Treasury securities, and I'm sorry, 80 billion of Treasury securities and 40 billion of agency MBS.
Right.
It continued to do that, and then in December 2020, it actually announced another flow-based asset purchase program in which it would just continue to acquire those securities at that rate. And it just, it just seems possible that decision, even though they could have at that time announced, a large finite asset purchase program, the decision to not rock the boat and to just continue to buy securities at that rapid pace, if within the Fed's own thinking, there's no real break on that activity, you can see how sort of the decision each time is going to lead them to come up with a larger and larger balance sheet.
Right. Sort of continuing on that, someone in our audience says, and if it's okay, I'm just going to read the question because I think they did a very succinct way of asking it. It sounds like you're suggesting that even as the Fed tapers and otherwise normalizes its balance sheet, that the fundamental determinant of reserve balances is bank demand for those balances. Can you elaborate on the process as you see it by which reserve balances actually shrink?
Sure, I'd be happy to. And that's a great question because, in the initial stages of the contraction of the Federal Reserve's balance sheet, the determination is simply going to be the Fed's reserve balances are, of course, determined by the size of the Fed's assets minus effectively currency, with the reserve balances making up the residual. So the reserve balances, as the Fed shrinks its portfolio, reserve balances decline. So, and that it's the Fed's action that determine the size of reserve balances. But what determines how small the Fed can get without causing interest rates to rise in an undesirable manner that's when banks' demand for reserve balances come into the picture. So right. At this point, the Fed has indicated that it's going to conduct policy with reserve balances that are sort of that are greater than the amount where interest rates start to pick up because of banks' demand. So my point is that bank's demand is to some extent endogenously determined by what banks have gotten used to, and importantly determined. It could be importantly influenced by if the Federal Reserve were to provide banks, an alternative to holding reserves to meet their contingency funding needs.
Do you think an SLR exemption for treasuries or reserves makes sense?
So, absolutely. But so the SLR, so leverage ratios as a general, as I'm sure the audience knows, basically banks are subject to two kinds of capital requirements: risk-based capital requirements, in which capital is divided by risk-weighted assets, and the asset weights depend upon the risk of the asset. And leverage requirements, where capital is divided just by assets with no weighting for risk. So leverage requirements are undesirable to have as your marginal capital requirement for a couple of reasons. One is that because they don't weight for risk, they actually create an incentive for banks to make their portfolio riskier. Secondly, they tend to charge high capital charges on capital markets intermediation activities like holding treasuries, and that reduce financial market liquidity if they're the binding constraint. Now, the Fed's actions and the Treasury's actions at the outset of the crisis and continuing to do so have made riskless assets a larger and larger percentage of banks' portfolios, reserve balances, and Treasury securities. And those actions, the more a bank's balance sheet consists of riskless securities, sort of the worse the leverage ratio performs as a capital requirement. So when the Fed adopted the SLR, and you can go back and watch the video of the live open board meeting, every board member indicated, first of all, that they expected the SLR to be a backstop, that it was adopted at a time when reserve balances were high. It was close to the end of QE3, but they were projected by the staff to go back down to zero, and so effectively to zero. So everyone around the table expected the SLR to not be binding and for reserve balances to be low. So making an adjustment to the SLR now to unravel, to remove the distortion caused by the high level of reserve balances is simply moving it back to the way it was intended to be. So ideally, you want your leverage requirement to be a backstop, and that would be a step at least towards putting it back into that setup.
Yeah. I apologize. I'm going to pivot back directly to the balance sheet because a few people have now asked this question, and I'm going to create an amalgam of the question if you're okay with it. And you had basically said in your remarks, tapering, then followed by, let's call it interest rate move, if you will. The question that's being asked is, do you envision a scenario at all, and again, I'm sort of putting this all together, where actual outright balance sheet reduction, not tapering, will come before a rate increase?
I don't think so. So this gives me an opportunity to emphasize that I basically sketched out two different scenarios, sort of scenario under past practice and scenario under what was a bit of a stress scenario. Both of those are laying out sort of the endpoints of how this could proceed. And no doubt the way it would proceed is going to be somewhere in the middle. And the New York Fed is likely to provide soon, within the next couple of weeks, its own forecasts of these things, and that'll be an important place to get further information. They have a lot more information on some of those paths. But in answer to your question, I don't think so for two reasons. I do think that it's completely possible that the Fed could begin to raise the target federal funds rate while tapering is going on. That would be inconsistent with what happened before, but the recovery was very gradual before. But to reduce the size of the balance sheet before raising the funds rate seems unlikely. First of all, and that's because partly that's not what the Fed said it would do. And also, when it considered this problem before, it initially actually thought that it might do something along those lines. But then it changed its principles to say, no, we're going to raise the funds rate first, and then we're going to start shrinking the portfolio. And one of the reasons that they were going to do that, they did that, and probably a reason that would still apply, is that once they're done using their balance sheet, they're going to want to put that in the background. They're going to want to basically say, our monetary policy tool is the Fed funds rate. We want you to pay attention to the funds rate. We want the balance sheet to largely wind down on automatic pilot. So I think that they would probably, again, decide to raise the funds rate first, so that that's where the public focus is on that tool of monetary policy.
Fantastic. So to that point, and we're opening up a can of worms here in a good sense. And again, thank you for giving us your brain during this sort of finding where we're going. Bill, one of your final points seemed to lend towards a return to the corridor system. Is this something you genuinely believe is achievable? And if so, how would you envision it occurring? And we talked about overnight repos and where that balance was in tightening the corridor, but maybe a bit more of a holistic sort of assessment with the amount of capital out there, I would guess.
Right. So, so as for many of you may not know, I'm actually one of the few people out there who are still sort of, you know, hopelessly clinging to the possibility that the Fed will return to conducting policy with a corridor system. I think it's a preferable system. It enabled the Fed to control with very small interventions. By having very small interventions in the repo market, it controlled a wholly separate market, the federal funds rate. Those rates were transmitted well into the economy. So with a small imprint, the Fed got to have good monetary policy control. And as we're seeing just over and over again, the idea that we're going to have a floor system that's going to be sort of a set it and forget it kind of monetary policy is just not playing out. And so they're ending up sort of with a much more involved in the financial system, with that involvement seeming to increase, and certainly no better monetary policy control, it doesn't seem. So how would they go about doing that? Now, what I sketched out was an approach to shrinking their balance sheet while remaining in a quasi-floor system. Because what I suggested is that they could get smaller, they could and move reserve balances down just to the point where market rates started to move above IORB, but at least would remain at our IORB. So in some sense, moving forward, expanding the balance sheet from that position, they would remain in a floor system. But if they were to contract reserve balances further, interest rates would move up again above IORB, and again move back into a corridor between IORB and the discount rate. Now, there is this sense out there, which I think in some sense maybe has to do with the fact that it seems so long ago that they actually conducted policy that way, that was some really super complex, difficult way to conduct policy that involved narrowly sort of hitting that target every day but that wasn't what it was like at all. It was relatively simple. I mean, the market desk staff back then was 200 people. That's the New York Fed's arm that implements monetary policy. Today, it's about 500 people. Now they've taken on other tasks, but nevertheless, it doesn't seem like we've moved to this sort of simple policy regime that we were promised with the floor-based system, and indeed one that the committee seemed to expect would be implemented with reserve balances of about $1 trillion. So anyway, the answer in some sense of what to the question is relatively straightforward. They would just need to continue that contractionary process that I described until they got to the point where not that market rates moved to IORB, but that they moved up above IORB and back to a place where reserve balances were scarce.
Wonderful. This one hits close to home because I'm a big fan of this sort of discussion, if you will, and I'm very intrigued to hear what you have to say. Do you think nominal R star could be different post-COVID because of either an inflation overshoot or higher productivity? But in general, what's the relationship pre-COVID / post-COVID to R star in your opinion? If you have anything really, that you feel strongly.
But I want to start by saying there are people who are much more expert in this question than I am. So I don't want to appear to overreach, but if growth productivity picks up strongly and remains stronger, that's going to move R star up. R star is in some sense sort of determined by, well, if government expenditures shift up to a much higher level and in a sustained basis, that also will move up R star. That's sort of an IS shifter that will move our star up. And on the other hand, if the Fed, let me think this through. If the Fed provides less stimulus through its balance sheet, then it will have to provide more stimulus. Then that's going to tend to move R star down. So we don't seem to be on track to that, but nevertheless, those are considerations for R star.
Thank you. And I think this is a really nice sort of summation question on the inflation front. Where do you see inflation 1 year out?
Well, if I'm a piker on R-star, I'm definitely not sort of a macroeconomist coming up with the macroeconomic forecast. So
Fair enough.
I will just pass on that and leave it to the folks who do those forecasts for a living.
Understood. Recently, you wrote that the Fed would have to be bigger if it issued digital currency. I believe that came out
Right.
recently. Could you expand on that a little bit?
Yeah, I'd be happy to. So that's another potential pitfall if the Fed were to want to try to get its balance sheet much smaller. And there's a couple aspects to that. One aspect is that if there was a digital currency out there, that's a liability of the Federal Reserve System. So unless the increase in the digital currency was offset by a decline in paper currency, which seems unlikely because most paper currency is sort of held abroad,
Right.
but for reasons other than just transactions, it seems more likely that if there were a digital currency, its growth would come partly by reducing deposits or investments in government mutual funds, things along those lines. But that if it was non-interest bearing, that would just be a larger balance sheet, would have to be bigger. They'd have to hold assets against that. That would actually boost their earnings, by the way. So because they would earn earnings on the assets, they wouldn't pay it on the currency. But what I think is much more worrisome and something that I haven't really seen any deep thinking on from the central banking community is, imagine if there had been Fed coin in March of 2020. The dash for cash, would have been a dash for Fed coin. If everybody has access, effectively, if everybody has accounts at the Fed, or if they have digital wallets with tokens that are liabilities of the central bank, everybody would have, in that panic, everybody would have moved into those into that central bank digital currency, into Fed coin. That's a liability of the Fed. So when it goes up, it's going to reduce reserve balances. The other sort of corresponding liability of the Fed, dollar for dollar. Bank deposits and government money market mutual funds went up a combined $3 trillion over that period between sort of mid-March and mid-April.
Yeah.
That money had all been going into CBDC, reducing reserve balances. I don't know how the Fed would have been able to offset that reduction. But if they wanted to be able to withstand that kind of a swing in reserve balances and still, adopt their hands-off approach to monetary policy, which is sort of underpinning the philosophy behind their large balance sheet system, they would need to have a much bigger buffer over structural demand to keep
Right.
structural demand well above, to keep reserve balances well above that level, despite variability. $1 trillion higher. It's really unclear how much higher, but vastly higher than the $300 billion buffer they're thinking about now. So to achieve that, they would just have to have reserve balances that were perpetually at a much higher level to be able to withstand that reduction. So that would be an impediment to becoming smaller over time.
Sticking with that, a question just came in that I think is perfectly timely when we're talking about the CBDC. If we move these deposits, they would move from the banks to the Fed, as we briefly discussed. If this happens, who would determine credit allocation, i.e., mortgages, business loans, things of that nature?
So if reserve balances were to, if CBDC were to grow to grow by a large amount at the expense of depository institution deposits, perhaps also then effectively what's going to happen is a relatively safe and relatively inexpensive source of funding for the banking system, and one that up until now, as we saw in March, is very well matched to banks' loan portfolio. March, deposits went up at the same time that banks draws on banks' lines went up. So as this is one of the advantages of having deposits and loans put together in one institution, is they tend to move together in tough times. If you take that source of funding away from banks, that makes it costlier to be a bank. So credit supply will decline. And just like economic analysis of the impact of higher capital requirements, which measures the increased cost of funding and therefore the reduction in the supply of credit and therefore the reduction in GDP, output would be lower. So I don't necessarily ascribe to the view that it would necessarily be the case that the central bank would have to or necessarily would go in and start making the loans that the banks are making. There are plenty of treasury securities and other securities for the Fed to meet the need to have an asset to correspond to its CBDC. But nevertheless, it would make intermediation much more expensive and would reduce credit supply, and it therefore would reduce GDP. It would reduce growth.
Thank you. If you're okay with one more, I know your time is precious, and then maybe we ended off with the same way you ended off your remarks. Fundamentally, why haven't countries provided financial institutions committed liquidity facilities, the CLFs that we talked about, or that you had mentioned earlier? Why haven't they provided these facilities to count towards their liquidity requirements at this stage of the game, in your opinion?
So glad to get that question, because it allows me to provide a little bit more background and detail on the committed liquidity facilities. So the committed liquidity facilities were sort of the last part of the LCR that was approved by the Basel Committee. I mean, they had been in there all along as a vehicle for jurisdictions that didn't have much HQLA, in particular jurisdictions that didn't have a lot of government debt. As an alternative to the central bank blowing up its balance sheet, they offered for those jurisdictions the possibility of taking collateral from the banks to back up a line of credit, charging the banks a fee for the line of credit, and counting that borrowing capacity as HQLA. It's actually a great idea, because it effectively passes it enables central banks to be the liquidity, to conduct the liquidity transformation that they're designed for, but it does so on in a way that can be applied internationally. Each central bank offers credit on its own terms, and if you didn't have some kind of unifying principle like this, it's very difficult to have an international standard that grants some credit for the capacity to borrow from the central bank. The Federal Reserve, for example, is kind of a reluctant lender at present. But rather, and I and others had encouraged the Basel Committee to adopt CLFs more broadly, to enable other jurisdictions, any jurisdiction, to use them, since economically, as I discussed, they're the same as a deposit. They're safe, they're prudent, and they offer a number of attractions. But the Basel Committee only did so for those jurisdictions that weren't short of HQLA on terms that don't really work. So in particular, the countries would have to charge a fee of, I think, 75 basis points if they weren't in a crisis on the undrawn amount, which is vastly over like what's it's so far over market that it wouldn't work. They also would only count towards, they would only be treated as what's called level 2B high quality liquid assets. So they would be treated effectively like equities rather than like reserve balances. So there would be some adjustments that would need to be made to the Basel standard, but more importantly, all of these rules are implemented by the U.S. banking agencies internally. So, and that's where the change, if they were to adopt this and incorporate it into, the monthly stress tests that the banks have to do and the resolution requirement, liquidity requirements that the banks faces, then all of those adjustments would need to be made. But those are made by the U.S. agencies, so they're manageable.
Wow, thank you. I think we've reached the end. Bill, in all honesty, thank you so much for taking the time out of your schedule and to speak with our membership and our guests. It's incredibly informative. By the number of questions that are still sort of popping in, maybe we could be kind enough to invite you again if you have some time down the road and continue the conversation into our audience. Thank you very much for joining us today. It's been a real treat. And we look forward to our next event, which will be probably towards the end of June, details to follow. Thank you so much, Bill. I really appreciate it.
Thank you, Alon. It's a pleasure and an honor to be asked, and I'd be happy to speak with you again. I'd be happy to answer anybody's questions if they want to shoot me an email.
Fantastic. Thank you, sir.
Bye-bye.
Bye now.